The year 2013 saw the end of the long bull market in bonds that began in 1980. Led by Fed policy, expectations of higher interest rates have driven down bond prices. In the face of low bond prices, individuals have increasingly turned to individual common stocks, as well as equity mutual funds and ETFs, in their efforts to build wealth. But to do so, they've had to overcome the negative psychology growing out of the financial panic of 2008. As a result, far too many waited on the sidelines after the recovery began in March 2009, and they missed much of the enormous run-up we've seen over the past 5 years. In fact, equity mutual funds only started seeing net inflows of capital in 2013, and as of year-end, those funds still showed substantial net asset withdrawals versus 2008. A significant percentage of investors manage their own portfolios, making trades via brokerage firms. However, the shock of the 2008 crisis wiped out the assets and the confidence of lots of these independent investors. So rather than manage their own portfolios, most investors invest in traditional mutual funds or ETFs. Today, about 20% of equity mutual fund assets reside in so-called index funds, which passively mimic an index. These funds charge fees that average roughly 13 basis points. The remaining 80% of equity mutual fund assets are invested in so-called actively managed funds, which should theoretically perform better than index funds even after charging on average roughly 92 basis points per year in fees. While still small, since the late 90s, the proportion of money invested in the index funds has been growing rapidly. Index funds are popular largely because a growing share of investors consciously or unconsciously subscribes to the so-called efficient market hypothesis, or EMH. EMH argues that with so much attention being paid to large-cap stocks, the opportunity to outperform the market is virtually non-existent. When combined with advantages of lower fees and relatively infrequent trading, selecting an index fund seems like a no-brainer to many. However, research and active real-world investing experience by the Trends editors confirms that the EMH is a myth that investors would do well to avoid. And ironically, the inflow of assets to index funds, especially those that track the S&P 500, is making the market less efficient and creating even more opportunities for outperforming the indexes. Why? Because index funds are mechanical constructs. They simply purchase a capitalization-weighted basket of stocks when they receive money from investors. They only change their selection and weighting when the index is updated. As such, they add no information to the system. This means that an increasingly small number of active investors is actually setting the prices, which are then simply accepted by the indexes. So, does this mean you should invest in actively managed mutual funds and ETFs? Well, the evidence certainly doesn't support investing in the average fund managed by the average fund manager. Why? Over the past 5 years, roughly 80% of large-cap mutual funds underperformed the S&P 500, and that result is consistent with performance generated over the past 60-plus years. That's mostly because active investors, whether amateur or professional, tend to be inconsistent in their approach to investing, as well as less than rigorous in their approach to stock selection. When coupled with the higher fees that active managers charge, you have a recipe for giving clients a poor deal. That goes for genuine gurus as well as run-of-the-mill fund managers. To review, first, contrary to the efficient market hypothesis, the indexes can be consistently beaten with the right strategy. Second, most actively managed funds perform worse than the passive index funds because few managers are analytically rigorous in formulating their models or consistently disciplined in applying them. On top of that, the high fees charged by active managers negate the net benefits of marginal outperformance. And third, market gurus who promise too good to be true returns may perform well for short periods, as Harry Dent did in the 90s and as Nouriel Roubini did in the 2008 financial panic. But they almost always crash and burn over the long haul. In the mid-90s, our editors set out to validate and exploit these three observations. The work started with a careful examination of the investment strategies advocated by successful and methodical investment professionals like William O'Neill, James O'Shaughnessy, and Nobel laureate Eugene Fama. The hallmark of these strategies was that they could be objectively assessed, validated in real time, and thoroughly backtested. The objective was to identify a very small but powerful set of strategies that would enable us to comfortably beat the major indexes year after year without taking excessive risk or incurring wealth-sapping fees and commissions, and that goal was fully achieved. Consider what we call the Strategic Wealth Advisor Premier Strategy. It started with our summary of James P. O'Shaughnessy's first book, Invest Like the Best, in which he laid out his research into the predictive value of a wide range of market-related variables. He later wrote What Works on Wall Street, which introduced what has become his firm's Market Leaders Value Strategy. O'Shaughnessy's methodology was shown to outperform the S&P 500 index from 1963 to 2013 by over 5% per year compounded, and it also outperformed it in all but one 3-year rolling period since 1963. More importantly, in live real-time trading over the past 12 years, it performed nearly twice as well as the Russell 1000 or the S&P 500 indexes. As a result, every $100,000 invested in this strategy at the beginning of 2002 grew to $439,502 by the end of 2013. By comparison, the same amount invested in the S&P 500 only grew to $205,136. And notably, the strategy beat the index with lower risk than the index funds. Our editors have refined and implemented this approach as the SWA Premier Strategy. As mentioned earlier, the key weakness of the passive index funds is using market capitalization as their sole criterion for stock selection and weighting. Research shows that size alone is not a particularly useful way to select and weight stocks in a portfolio. To replace market capitalization in the selection and weighting process, our editors employ the stock selection criteria that have been shown to be the most predictive of strong future returns across U.S.-listed large capitalization stocks. The resulting model, featured in our Strategic Wealth Advisor newsletter, favors companies with attractive valuations and strong yields, while avoiding companies with bloated and unsustainable balance sheets, poor earnings quality, and poor recent earnings growth trends. Fortunately, each of these criteria can be objectively measured using publicly available data, and then applied with the same rigor and consistency that passive index funds use. This eliminates the emotional element from the trading process. Here's how the SWA Premier Strategy 5-step evaluation and selection process works. 1. Focusing on large and mid-cap stocks, evaluate earnings based on both profitability and quality of earnings. 2. Use balance sheet data to avoid companies that are highly leveraged, borrowing at an excessive pace, or have insufficient operating cash flows to service the interest on their debt. 3. Evaluate the yield on each stock, combining dividend yield and the rate of share repurchases over the prior 12 months. 4. Focus on the most important factor, valuation. To do so, use metrics like price to earnings, price to sales, and price to book. Research clearly shows that stocks that look cheap based on all of these valuation metrics produce the strongest future returns. And 5, once the best stocks are selected, allocate the investment in each of them equally, instead of weighting them by market capitalization as the major indexes do. O'Shaughnessy's firm implements the market leader's value strategy for high-net-worth clients via managed accounts with broker fees which eat into realized gains. That's the price you pay to have one of the few great money managers who has beaten the markets year after year manage your money. We launched Strategic Wealth Advisor to give subscribers access to the carefully researched strategies that have beaten the indexes year after year, so anyone can execute them, at or below the cost of an index fund. Most importantly, adhering to the Strategic Wealth Advisor strategies eliminates stress and anxiety because it clearly tells investors using a particular strategy what to do and when to do it, based on solid empirical evidence. So there's no more worrying about short-term swings in the market. Trying to time the markets becomes a thing of the past because you stay invested in the stocks that perform best through both up and down markets. What's the bottom line? Between now and 2033, the Dow is likely to soar to over 75,000, while the S&P 500 is expected to rise to well over 9,000. Those who avoid the too-good-to-be-true charlatans and simply invest in passive index funds like those offered by Vanguard have a chance to earn a 500% cumulative return over the next 20 years. Meanwhile, those who adopt the kind of well-considered active strategy found in the Strategic Wealth Advisor newsletter could turn that 500% rise in the market indexes into a return of 800%, 1,000%, or even more. While past performance is no guarantee of future returns, consistently applying a strategy that has outperformed the indexes for over 50 years is likely to produce superior results in the years ahead. In both bull markets and bear markets, you'll know what to do. To learn more about the Strategic Wealth Advisor strategy for high returns at low risk, visit us at strategicwealthadvisor.com or call the Business Briefing staff at 1-800-776-1910.